Welcome to Tesla Deep Dives.
The topic today, the Unstoppable Conglomerate, strategic necessity or regulatory nightmare, analyzing the Tesla, SpaceX, and xAI mega merger. The Muskonomy is facing its biggest consolidation challenge, the hypothetical, but increasingly plausible, mega merger of Tesla, SpaceX, and xAI. This isn't just a corporate deal, it's a structural pivot for a nearly $2 trillion industrial and technological empire. Our core question is simple. Is this the strategically necessary, vertically integrated physical AI ecosystem, or a regulatory nightmare masked by a sci-fi vision? The context for this speculation intensified following the reported acquisition of xAI by SpaceX. While still two private entities, the transaction, reportedly valuing the combined company at up to $1.25 trillion, with xAI at around $250 billion, signaled Elon Musk's intent to unify his interests. This move positions a prospective SpaceX IPO not as a pure-play aerospace stock, but as an AI space behemoth, a point that has already raised concerns among aerospace sector analysts. The strategic necessity narrative, championed by Musk, centers on physical AI and orbital compute. The integration aims to connect xAI's intelligence, Grok, with Tesla's hardware, full self-driving and Optimus robots, and power infrastructure, energy storage, all leveraged by SpaceX's Starlink network. The most radical synergy is the vision for space-based data centers, with Musk projecting Starship could launch enough satellites annually to provide 100 gigawatts of AI compute capacity, citing the infinite access to solar energy in orbit. This vertical integration is already underway. Tesla has committed approximately $2 billion to xAI for compute resources. The bullish Wall Street perspective, exemplified by Wedbush analyst Dan Ives, sees a growing chance of a full Tesla merger within 12 to 18 months, viewing it as a move to give the connected tissue between both disruptive tech stalwarts in the AI revolution. However, the financial counter-narrative warns of a potential bait-and-switch for shareholders. Critics, including analysts on Seeking Alpha and The Guardian, have labeled the xAI acquisition by profitable SpaceX, which reported $14.2 billion in 2024 revenue, as an effective bailout for the loss-making, cash-burning AI startup, drawing uncomfortable comparisons to the controversial Tesla SolarCity deal. The specter of dilution haunts Tesla shareholders. As John Struer of Boston Common Asset Management noted, determining a fair price for the private entities is complex, and if their valuations are perceived as extremely high, it will be viewed as dilutive to Tesla shareholders. This valuation scrutiny is amplified by xAI's comparative trailing of rivals like OpenAI and Anthropic in the competitive large language model race. The regulatory hurdle is complex. A former FTC chairman, William Kovacic, stated that a cross-sector merger might bypass typical antitrust concerns, since the companies do not directly compete. However, the sheer size of the projected $3 trillion-plus entity and its control over critical global infrastructure, from space launch to AI to mobility, raises deep national security and systemic risk questions that will inevitably draw the scrutiny of the FTC and global bodies like the EU. The public market sentiment, however, is currently dominated by the upside narrative. Tesla shares surged 5% in early 2026 after initial reports of the merger speculation, reflecting investor optimism for streamlined operations and AI-driven growth. This bet on Musk sentiment, summarized by Zacks investment research strategist Andrew Rocco, who notes that most Tesla SpaceX investors are invested for the sole sake of betting on Elon Musk, seems to outweigh the technical and governance concerns for now. Ultimately, the mega merger is a profound gamble. It is structurally brilliant, consolidating capital, talent, and AI's full stack from silicon to orbit. The predicted success hinges on the technical feasibility of orbital compute, which one analyst, Dhiren Pichai, warned is more complicated than it appears on the surface from an engineering standpoint. Our synthesis concludes that the merger is a strategic necessity for Musk's ultimate vision of a unified physical AI ecosystem, but it is an undeniable governance and regulatory nightmare for minority shareholders and public oversight bodies. The The potential upside is astronomical, but the risks of cross-subsidization, opaque valuation, and single point of failure leadership are equally immense. The market is currently pricing the potential for technological hypergrowth over corporate governance stability. Investors should monitor 3 key indicators in the coming quarters. First, the official valuation and structure of the eventual combined entity's IPO. Second, the Starship launch cadence, which must reach sufficient frequency to make the orbital compute concept economically viable. And third, the commercial progress and safety ratings of Tesla's FSD and Optimus robot initiatives, as these are the terrestrial endpoints for the combined entity's intelligence. Any faltering in execution will quickly reignite the bailout narrative and trigger a market correction. Final prediction: a full, formal merger of all 3 entities is likely within the next 2 years, driven by Musk's need to secure AI compute for the entire ecosystem and leverage SpaceX's private capital pool. The legal and regulatory battles will be intense, but ultimately non-blocking, making this consolidation a defining moment in the history of industrial conglomerates. Let me know what's your thoughts and leave your comments. Thank you for joining us for this deep dive. To ensure you never miss a pivotal analysis, please like the video, subscribe to the Tesla Deep Dives channel, and hit the notification bell. Your engagement fuels our critical research.